Hey guys, I just wanted to jump in for a second and let you know a little bit about today's live stream sponsor, DNA Funded. DNA Funded has very generous profit sharing up to 90% and 3 different unique challenge types. For those looking to get funded, they also have speedy payouts, unlimited trading days on the first and second phase of their challenges, a very wide list of different things you can trade with over 800 different assets tradable, and maybe the most important component, a very experienced team behind the whole operation. So if you're interested in learning more about DNA Funded, click the link, check it out, see if it's right for you, and make sure to do your own due diligence to see if what they have to offer fits your trading style. For 20% off, you can use code A1T20. Again, that will be 20% off any of their challenges you'd like to check out. Thank you again to DNA Funded for sponsoring today's live stream. Now back to the show. Hey guys, ladies and gentlemen, welcome back to another live stream, and cheers to the Bulls. Fellow Cat Dad here. Good to have you back on another day. A lot better of a day for me personally than some of the ones we've had recently. I will take this day every single day. If we could just get 30 more of these, then I would go ahead and retire. Anyways, S&P 500 is ripping here. Ripperooski up 2.87%. That's the SPX, but take a look at the SPY up a whopping 3.3% in the pre-market. Markets are absolutely ripping. Now, I'm going to be obnoxious if you're a bear, and I apologize, but if you're a fellow bull, then this is really what we've been looking for. I think we might actually have signs here of a bottom. Now, I have to be careful with that because I said that over here and I was wrong. So let me back up my opinion on why I think that we may have just seen the bottom for the bulls. And if you're in this with me, this is why we don't try to time bottoms on a long-term perspective, okay? We had news this morning that China wants to talk, okay? And this is the biggest opponent. This is the final boss. So if China wants to talk, according to Trump, if China is like, let's negotiate, let's discuss all this stuff, you know what that means? That means the big boss, the big op, the big antagonist in this story. I mean, I guess maybe you could say, depending on who you ask, maybe Trump's the antagonist, maybe China's the antagonist. I don't know. But one side of the aisle saying, let's negotiate. Trump, of course, took to social media immediately in typical Trump fashion, saying they want a deal. They want to make a deal, right? So that happened this morning. Markets up, ripping your face off rally. This is why, ladies and gentlemen, I do not like to short the indices, and why I have been screaming, pounding the table. I've been Donkey Kong over here. You don't chase sell-offs for this exact reason. The put to call ratio could be yet again signaling the bears are going to get crushed. Okay? Let me show you why. I cannot tell you how many people in my comment section in the last few weeks have been saying, Nick, it's not too late. You should just be short. You should just be bearish. And I guess short term, to their credit, they were correct, right? And this is not necessarily over. So don't get me. I'm not getting ahead of myself. I'm not all in leveraged long. So just understand, this market has been going down, and in the last like 48 hours, the bears got so loud. This weekend, my Sunday video and my Monday video, people are just outright howling bears, right? They're just, what do bears do? What the bears, they don't howl. They roar? What do bears roar? They've been super loud. And the reason I say this is because that's typically what happens at the bottoms. People get obnoxiously loud about being bearish. This looks like, again, it's too early to call this, but it looks like a capitulation bottom. That's the type of candle you get at a bottom. What do I mean by that? Well, typically when markets are bottoming out, everybody gets bearish at the worst possible time. Check, everybody's bearish, right? Put to call tell you everybody's bearish. Even if you're not necessarily bearish yourself, what I'm saying is that the consensus is extremely negative out there. So if everybody's saying, oh, I'm cautious, or I'm bearish, or I'm short, or I sold my stocks, that typically happens at the end. That does not happen at the beginning. People are not smart, unfortunately, in markets. They do what the crowd does. People were all in long here, and now everybody's sold their shares, sold their positions, and bought puts. Now, I'm not teasing people who have done this. I'm telling you what has consistently for as long as I've been watching the markets, what has happened. At the end of bear market moves, right? Or at least short-term bottoms, what happens? People get incredibly loud. Okay? So, look, could this be a fake move and we go lower? It could. But what I'm telling you right now is that shorting in these candles is not only difficult, but it's outright, in my opinion, it's outright dumb. I'll tell you why. This is my opinion. All of this is, of course, my opinion. I could be wrong. Markets could go lower. You know the drill. But when everybody's bearish, the cost to buy bearish bets goes up astronomically, goes up massively. If you wanted to buy puts the last few days, you paid an arm and a leg to buy puts. What do I mean by that? Well, puts are bearish bets, and to buy them, you have to pay a premium. That premium has gone up tremendously. So if you wanted to bet that this market's going to go lower, okay, let's say you bet it's going to go down here, right? Well, in spread, aka the premium, you might have paid this much in premium. So if the market goes anywhere above this area, you lose money. That's what puts are not telling you about. This is what happens every time we hit a market bottom. This time is not different. I will be obnoxious about that. People are saying this time is different. That is an indicator that it's not different. Okay? When everybody's saying this is the end of times and this time is different, Fed's not going to save the day, Trump's not going to save the day, right? When you have everybody saying this time it's going to crash, I will take 99.9% of the time that's a good chance that you're getting closer to a low than you are to the highs. So yesterday I bought a lot of stocks. I bought a lot of stocks yesterday. I also bought gold yesterday. Nice bounce back on gold. But I just want to caution you. Let's say you disagree with me. Let's say you're watching and you're like, no, Nick, you are wrong. This market is going to go lower. Fine. I'm not saying I know that for sure what's going to happen. But let me just hope that if you are a bear, you are being constructive and not chasing. So if you are a bear, right, then you know what I'm about to say. If you're a bear and you're being constructive and you're being patient, Chris Pulver and I had a conversation like this yesterday. He kind of leans more bearish recently. You know what Chris said? He said, let's wait for something like this. Get the bulls out of the way, and then bears could take it over again. But again, I'm speaking right now about the people who absolutely took huge bets. Do you guys know there was a liquid options exchange happening for 20% down on the options chain yesterday for SPY? If you know what that means, you know what it means. People were making bets yesterday that the market would drop 20% in a day. I've never seen bearishness like that. Never. I've never seen it in my career. I've never seen people be so outright negative about the markets in my life. And I've been doing this for a long time. I saw 2020. This seems like more bearishness than 2020. And what happens? What happens next? Again, I'm not saying that this is the low and that we're going higher back to the highs from here. That's not what I'm saying. But understand that sentiment that we had yesterday, even if you are a bear, I think it's reasonable to acknowledge, yeah, everyone got bared up. Everyone got bared up. And in typical fashion, what does the market do next? It kills that chasing mentality, right? Everybody thought, yes, Lincoln, you're right. Literally, people were saying it's going to be Black Monday and positioning as such. People were outright, like I said, so if you don't know what I meant by like there was an exchange or There was contracts trading 20% down in the S&P. On the options chain, right, for the S&P 500, I'll just show you really quick. So if I go SPY and I go options, people were trading 0 DTE options 20% below current price. Like 0 DTE options 20% in a day. That's never happened before since 1987. One time did the market go down that much in a day. So my point is, we have not seen that kind of like bearishness, people making massive speculations that the market was going to crash. And what did the market do? It closed positive yesterday. What's it doing today? It's ripping higher. So like I said, the market could go lower. I'm not saying, oh, this is over, it's done, it's all good from here. That's not what I'm saying. I'm saying sentiment matters. This is why traders pay attention to sentiment that know what they're doing, right? We look at these indicators and we say, oh, even if you're bearish, careful, right? You are chasing like no other chasing if you're bearish right now. I'm sorry, let me rephrase that. I'm not trying to disrespect people who are bearish, right? If you are bearish and you have a good reason, great, no problem. What I'm saying is if you are super leveraged short and you are ignoring what I'm showing you here, I'm just saying be careful, because this is quintessentially what people do at bottoms. Okay? We have moved since everybody called for a Black Monday. We're up 9% in 2 days. Remember that when the market's crashing, right, it can move down lower. But you know what's just as strong in bear markets? Bear market rallies. Okay? Bear market rallies. So even if you're bearish, this is why we don't get bearish at the worst possible time. This is why if you are bearish, you wait for the bulls to have a turn. And then if you're still bearish, then you can do your shorting and you can look for those opportunities. You do your thing. I'm not here to tell you what to do. I personally won't be shorting this market. I'm going to continue to add stocks, and I hope it goes lower. I hope it goes lower because I want to continue to buy stocks. I think this is a long-term generational opportunity to buy stocks low. That's my personal opinion. I could be way early. I don't really care. For the long term, I really don't care. In fact, for the long term, I hope this thing tanks another 20%. Because then I could really get some stocks at great prices. US stock market just opened up, and there it goes. We'll see some volatility pick up here in the 9:30 trading hour. Should I buy Tesla, lads? I mean, Tesla's your ultimate proxy, right? I am very long Tesla, but understand Tesla is very, very high risk, high reward. So let me also disclaim something. If you're feeling, oh my gosh, I missed it. Oh my gosh, the market's bottoming. Relax. This market is so volatile. We could be down 2% by the end of the day. We could be up 6%. But this market is right now, I'll tell you what it's doing. It is rewarding people who are stepping in, who have been waiting cash heavy for a long time. Here's my opinion on this. And then all of this is opinions. Like, people are disagreeing with me left, right, and center on my videos. That's fine. I don't care, right? But I'm going to give you guys my takes on this stuff. I think this is a long-term opportunity for people who missed. I'm not talking about, you know what's happening right now? Rich people that own stocks, specifically hedge funds, many of them are in the process of aggressively deleveraging. Okay, what does that mean? Market's been going up, 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 up. Hedge funds, just like retail traders, get caught up in leverage. They're like, oh, everything's so good for markets. I'm going to make a ton of money for my clients. We're going to go take a loan out with the bank, and we're going to go long NASDAQ. Well, right now we've seen an interesting sell-off move, which is, in my opinion, massively rewarding the patient investors and managers in this market that did not get greedy and chase. Market has a funny way of doing that. What's happening is a lot of investors, a lot of hedge funds, in my opinion, right now, are deleveraging. They had huge bank loans, and they needed to cover their positioning and get out of the way. And so we saw massive sliding selling, right, in record time. And this big selling may have led to, some margin calls or straight up margin calls on the hedge fund level, which can cause more selling. Is this all over? We'll see. From a trading perspective, what I'm looking for this week would be CPI and PPI to come in soft. What I mean by that is cool. We want low numbers. Okay. Low numbers gives the Fed the opportunity to cut rates. Fed cutting rates could potentially be yet again what saves the day to this market. That's what's happened the last 10, 15 years. The market goes down a ton, Fed can step in and cut rates. These figures are important this week for that very reason. If you're going to get the Fed put, quote unquote, that saves the day, we need inflation that is not problematic. Okay. What do you think about gold? I'm long gold. I picked it up yesterday, got it at the 61.8 and reversed almost immediately. I'm looking for an opportunity to trail stops on this one. I think gold has more upside. I'll tell you what, here's one of the reasons I like gold personally in this environment. You're having a big short squeeze day today and people rushing back into stocks. I also think it's very worth, in my opinion, watching gold. Here's why I like gold. I think gold offers a middle ground for people who are like, okay, we might be, things might not be, tanking and cratering, but I don't think this is necessarily over. Well, that's been part of the reason gold's been attractive. I think it will continue to be a reason why gold is attractive. I also think that central bank buying is going to continue to ramp up for gold because clearly the US and China relations are like this right now. China's a big gold buyer. And I think as they potentially deleverage from US denominated stuff like US treasuries, they may accumulate more positioning in things like gold. So I like gold quite a bit to the long side. I am long currently. I have a good size position on this one. I'm also quite heavily long US stocks at this time. I really went shopping in the last 2 weeks. I by no means caught the bottom, but I've been accumulating this leg lower. I've been very much building into stock positions that I like for the long term. So we'll see. So I have a long position on gold. I have several stock positions. You can see my list of stocks here has grown quite substantially. I'm long Fortinet, Intuitive Surgical, NVIDIA, Meta, Amazon, Salesforce, Google, PayPal, Uber, Robinhood, American Express, Airbnb, Tesla, Home Depot, and Apple. I have shares in all of these companies and will continue to add to those names if this market goes lower. Like I said, there's a lot of volatility out here, and I hope it goes lower in terms of a long-term perspective. Short-term, my portfolio will look red if that happens. But long-term, I'm not leveraged, so I'm not going to die if it goes lower. And in fact, I would actually get, in my opinion, better prices for the long term. VIX is down 17% today. That is a volatility drop like we saw. And again, this story plays out time and time again. Time and time again, guys. Volatility goes parabolic. Everybody's convinced the world's going to fall apart. Bears get super loud in the comment section, and then this happens, and they all go quiet until the next one happens, and they lose a bunch of money. That's the story of markets. Patient, long-term, focused individuals and traders, not greedy, not leveraged up to the T, patiently waiting for opportunities, sticking to a system, tracking sentiment in the markets, good risk management with trades they're taking. Those are people who get rewarded in these environments. People have waited for a long time to get stocks on sale. And you might think, well, they might go more on sale. That's fine. But for me personally, the way to approach this, the way I am approaching this, is accumulate slowly, fully aware I'm not going to catch the bottom. Those are long-term positions. I don't care to catch the bottom. But I do care to get them at prices that I think are good deals. And I think Meta, you got Meta, one of the greatest companies on earth, in my opinion, down 34%. Give me some shares of Meta. I'm buying, right? I have to for the long term. And you know what? You might say, well, Nick, you silly monster, you're gonna be way early and that thing's gonna go down to 350. I would say to that, I'd say, do it, please. Send it to 350. Because at 350, 50% off Meta, I'll buy more shares. Not leveraged, not making a gamble. I'm not all in. I'm accumulating shares every day that the market goes down. And so I hope the market keeps going down. But it might be bottoming out because, again, sentiment would be telling me that it's reaching extremes, and that sentiment is telling you everybody is already convinced it's going to crash, and that might just be why it's bottoming out. The other thing is that China, I mentioned this earlier, but for people who are just tuning in, Trump went to socials today indicating that China seems very keen on making a deal. He put a pretty big ultimatum on China. Markets sold off on that ultimatum. Now, potentially some positive news out of that relationship. Very, very soon to call that kind of thing. But any news, you can see how violent the market's reaction to positive news is at this time. And you're seeing a sharp bounce back in things like NASDAQ, S&P, pretty much all equities. Take a look at Japan. Chinese stocks up a little bit here today as well. DAX is up 2%. Russell's up 2%. Again, this is why it's hard to be a bear. If you're bearish and chasing, one day like this can blow you up. Is your portfolio 100% stocks, or you have a portion with bonds? That's a good question, Mark. So right now, I'll tell you, here's my distribution. I'm about 40% long gold as a trade, and 60%. Let me take that back. I think it's like 10% cash still, and 50% in stocks. I think that's about a rough number of my exposure currently. So I'm 50% mostly in tech stocks that I like, that I've recently bought into, heavily focused on tech. I know, very, very millennial of me. But I like tech stocks. I like software companies. So anyways, 10% cash, 40% trading gold longs. So 40% of my allocated cash in the portfolio is currently sitting long gold. So I have a good size position in gold right now. My initial trade on gold was a little bit smaller. Second position here is bigger. So yesterday on my videos, you might have seen I was long gold at this level, and I actually closed out early ahead of my stop loss. So I'll just pull up the record so you guys know I'm not just making this up here. Hold on. Let me go to my trade alerts here. So yesterday on my gold trade, what I did is I closed out early. This price action looked ugly on the intraday level. So I actually closed out of my trade on gold and then bought it back. $20 an ounce lower. So I bought back in on gold yesterday. And I mentioned in my post to members, where is it? Slightly larger size than my first attempt. I like this trade a lot better. This setup to me looks really good on gold. I think we were due for a couple days down of capitulation, and I laid out my bull case for gold. I think that, again, there's a case to be made, in my personal opinion, that China and other countries may want to move away from US dollars, but that also concerns about a global recession could lead to a lot of printing of currency all over the globe. Also a bullish catalyst for gold. Economic data has been coming in a little wobbly here. I mean, I have a very bull case on gold for 2025. So this pullback, I think, was really needed. I think we got a little bit of a margin kind of activity yesterday, a little bit of selling across the board. Gold got mixed into that, as it usually does in times of, liquidity crunches globally, like when we see margin calls happening and things like that. Gold actually does get sold alongside other things as people just grab for cash. But what we saw in 2020 was something similar to that, and gold actually ripped back to the highs within a few weeks. If you remember, if you've been trading in 2020, you remember what I'm talking about. In 2020, you had a very brief bearish move as global market liquidity, like, people were rushing for cash, right? But let me show you how this played out in 2020. Going back to gold here on the daily chart, you can see that in 2020, you had a violent sell-off of assets across the board. Gold saw a 14.7% move lower during the COVID crash. Stocks did 30, right? So gold held up pretty well, all things considered. And within a few weeks, bottomed out. And within a few weeks past that, was up to 1,700 an ounce, which I believe was an all-time high. So we hit new all-time highs within a few weeks of the COVID, crash. The reason I'm bringing that up is stocks took much longer than that to get back, first of all. But second of all, Gold sort of gets that initial sell-off with everything else in recession concerns, just because people are like, oh, I need to raise capital, right? So I mentioned that margin crunch that happens for a lot of funds that were leveraged going into an event like COVID or going into this recent event. So you see a lot of people grabbing for cash. They also end up selling gold initially. So if we see a similar pattern, gold sells initially, people raise cash and liquidity, and then gold becomes an attractive, in my opinion and my experience. I think that is likely to be the case in this scenario too, where you have people selling everything first, right? And then as people look to get back into stuff, where do they go first? My opinion, and this is not like, none of this is financial advice, I'm just sharing my opinion, my trades. I'm going to lose money if I'm wrong. I'll make money if I'm right. You do you. I don't care what you do. But gold is a first entry attractive rebound move in my personal view. Look at this. Nas up 3.2%. We are absolutely ripping today. 2.86%. Trump will take this market further, tank this market further. That is the goal here, to make as much money as possible. Once that happens, they will buy market and make money again. Igor, I put out a tweet. Just, I do want to just urge everyone under Biden, right? People just, it made me so frustrated. Just like this situation makes me frustrated too. People love to blame politicians for why things are happening. Now, I'm not saying, you might say, well, obviously Trump's tariffs are causing the market to sell off. Well, yes. But when people kind of put blame on others, it's a really dangerous way of thinking. Now, again, I was frustrated by this when it happened under Biden and everybody blamed the entirety of inflation on Biden. And I'm also frustrated by it now, where people are like, the market crash, the reason I'm losing money is because of Trump, right? So I would just urge you to just be careful with that way of thinking. We talked about this in my group yesterday. I actually put out this message that said, because this is a quote, I'm seeing this all over my socials. A lot of people are looking for something to blame in this market sell-off. Because of Trump, my portfolio tanked, or Biden's inflation caused my account to blow, are both terrible takes. Back in 2022, people were saying that about Biden. Biden crashed my account. Inflation is all his fault. And people get really up in arms about politics. I'm not here to debate one way or the other, but everybody has their opinions. But winners, right? This is my honest opinion on this. Like people who like win, who do well for themselves in the world, they might not like Trump, they might not like Biden, but they don't blame them or use them as scapegoats for their own underperformance, their own mistakes, their own stuff like that. Thinking like this will routinely keep you blowing accounts in trading. Great traders take 100% responsibility of everything that's happening in their accounts. Losing traders are constantly blaming the next disaster for why they weren't profitable this year. Rain or shine, red or blue, war or peace, your account is on you. Take ownership, be strong. I really think this is an important message, that we talk just for a second about internal versus external locuses of control. People who have an internal locus of control believe that they can determine their future. They can make things happen, right? External locus control is believing that everything's just happening to you and you're just a victim to what the world is doing to you, right? So I just want to encourage people, be careful with your mental psychology during all this too, right? If you're dealing with a drawdown, own it. If you were wrong about something like I was, right? I was wrong that the market was bottoming over here. Own it, right? Own it and move past. That's how you constructively work towards the future, right? But if you say like, oh no, this market's a scam, or, the administration's ripping us off and they're going to do this, and then I'm going to no, come on. Let's be, take ownership about what's happening. You may not like Trump. You may not like Biden. That's not what the conversation is about. Conversation is about being a doer and being proactive about what's happening and taking ownership, right, of whatever's happening. So just something to think about. Not just owning, but also learning from it. Exactly. Yeah. Great point. So we'll see. Nasdaq's up 3% here today. I mean, when we take a look at Qs, look at the Qs. Look at this. 3.5% in one day. Crazy. Crazy. VIX is down 19% in a day. Crazy stuff. So yeah, I think like I said, even if you are bearish, I discussed this earlier at length, but even if you're bearish, I think like that's if you have concerns that we're going to see global recession, if you're concerned about how trade dynamics changing could really, and if you think that negotiations are not going to go well, that's fine. I would just encourage you to be careful with letting your political bias get in front of you. So, you know, when people were terrified about inflation, right, under Biden, people were like, Bidenflation, Bidenomics, teasing that. I would just say, just be very careful. I actually don't like, in my opinion, personally, because I have to trade the markets and this is what I do. I don't like to really focus too much on the negatives of politics. I do it as little as possible because I know that if I go down that rabbit hole, it infiltrates what's happening here about my trading, right? So I'm not a big fan of, political garbage that's out there and watching it all day long. Hey, thank you very much for the $2. Appreciate that. Ye's World or Ye's World. You got to tell me how to say that. That's a cool name. Ye's World or Ye's World. Nick, how are you looking on currencies? Yeah, let's do some currencies. So all this craziness, by the way, NASDAQ 3.3%. Holy, what a rip. Let's see if we can hold it. Now, before I move on to currencies, appreciate the $2 donation, by the way. We'll take a look at currencies for sure up next. Real quick on this, yesterday we saw these gains come flying in, and we actually ended the day pretty much flat. Let's see if today we can follow through. Let's see if we can take out, I think from a price action perspective here today, guys, what you want to see on a daily perspective would be to take out that wick high. Can we get something like this today? And then that next milestone is the 19,200 level that we completely flopped off of. We're headed back up there. This is where, again, Chris and I talked about this. If you were bearish, this would be, in my opinion, a much more constructive view than trying to short down on the lows when everybody's already been doing that and everybody's already bought puts, and you're fighting a real hard fight to try and be bearish at these levels. Up here, I think there's a good, fair case to be made. So that's the final thought on indices. I'm not bearish at those levels. I'm just pointing that if you were, that to me makes a whole lot more sense than trying to short at the lows on the daily. So from the bullish perspective, what am I looking for? I'd look for something like this. I'd look for breakouts, failure of the bears at those levels to give me signs, okay, we may actually be truly bottoming out. Anyways, let's take a look at currencies let's see where are we at. Currencies, euro dollar. The only way I can get his attention. I appreciate it. The $2 donation will go right towards the coffee fund here at A1. And I apologize. I know I'm not always great with the chat. I do my best to keep up with what's happening there, but trying to like present and read chat is also difficult. I try and keep the show moving because we got a lot of stuff to cover. Anyways, I appreciate the donation to the stream, and let's definitely take a look at some currencies. How are they impacted with all this? Well, the euro, well, actually, first of all, let's take a look at dollar index. Dollar index is doing what? Dollar index is lower here today. Came back to this 103.5 level of resistance. I do remain pretty bearish on currencies on the dollar recently. You're kind of seeing this. This is just showing you how aggressively selling off this dollar index is. Came back to key level of resistance here, 103.5. Sellers came in, at least for now. We'll see if they can hold those losses. It's tricky, right? The dynamics of trade war stuff. Is it good or bad for the dollar? Well, the market's been recently telling you it's perceived as negative, right? Trade war, issues escalating seem to be actually perceived by the market as a negative for the dollar index, for the strength of the currency, because again, the idea would be that it's going to really hurt the U.S. economy. and maybe take it down a few notches. So the dollar index has been under pressure. I still think that the dollar bearish train may continue and that we may truly see a push down towards these lows, but it's really going to come down to this week what happens with the CPI report. If you get inflation cooling plus all this trade war uncertainty, dollar index could very well see 100. So I remain pretty bearish, tactically bearish on the dollar at this time. The other reason is if we take a look at the US economic heat map within the Edge Finder, let's see where we're at. So last CPI report was actually pretty good. Like last CPI, early March, we saw cooling inflation, both on the PPI and the CPI. And then we had a miss or a worse than expected, higher than expected number for PCE. So we're getting our latest round of inflation data. And what we absolutely do not want to see for the US economy would be an uptick in inflation. Now, if you're bullish on the dollar, you would want to see inflation come in hot, right? Because that would mean Fed's not going to cut rates or going to try harder not to cut rates. Whereas if inflation's cooling more, the Fed can cut rates, bearish for the dollar, bullish for stocks. So inflation's going to have a big tell this week. We have that coming in the next few days. So we'll have CPI and PPI on 2 separate days. I believe it's Wednesday and Thursday, I believe. Is it tomorrow? But so yeah, that's something to think about. Is we have inflation reports coming out that could tilt this thing pretty heavily. If you get, for example, let's say hot inflation, right? Higher than expected inflation, meaning the forecast numbers versus the actual surprise to the upside. And this turns red because that's negative for the economy, but bullish for stocks. I'm sorry, bullish for the dollar. Then dollar could actually flip bullish and we may actually see some breakouts. So you need cooling in inflation, I think, to keep this dollar trend going down. So that's what I'd be looking for. And I also think that that would be a very positive thing for things like gold. You may see further upside on gold if you get cooling inflation. And you may also see crypto and you may see stocks, which look at that, 3.6 on the NAS now. My goodness. You may get that kind of big reversal. So dollar index, like I said, technical signals for me would be looking for the dollar to break back through this low at 102, in which case I think we're probably headed down to 100. Path of least resistance for me would be to continue to be bearish on the dollar until further notice. Let's hope from a perspective of, economic conditions that the dollar continues to move lower, not necessarily because demand side and growth side is crushed, but rather because inflation's cooling. So let's see. Taking a look at the euro, though, I think euro has upside. I think that upping military spending in combination with, just the dollar weakness that we're seeing could continue to make the euro look relatively attractive as an alternative option. So I am still long the euro. I'm looking for a push back up to like this 1.12 level. If that happens, I'm probably going to look to take profits on the move. I'm long Kiwi dollar. This bounced back nicely. I was in the red this morning. Big pop here this morning on weaker US dollar movements and, of course, risk on sentiment in regards to China-US relations being potentially, again, it's everything is so fast right now. By the time, this afternoon comes around, things could have soured or we could have a deal on our hands with China and the US. It's really hard that's why this market is so volatile. But volatility is contracting. You got the VIX down 21.3%. So very, very interesting. Nick, bank analysts thank you very much, by the way, for the donation to the stream. Appreciate you on that. Bank analysts are saying that recession indicators are higher than before. Does that bother you? I watched on Bloomberg and CNBC. That's a good question. So I've seen a lot of that too. A lot of analysts are taking their targets down for the S&P 500, meaning, going into this year for SPX, a lot of funds, including myself, by the way, so this is not aging well, had targets on the S&P 500 of 6,500, 7,000, 6,800. This was their year-end target. Now, what Aura TV is referring to with his message is that recession, or people are claiming there's or analysts are putting out research saying that there's a higher probability of a recession. And with that, they are also bringing down their forecasts for where they think the S&P 500 will end out the year in 2025. Okay, so a lot of people, a lot of analysts, the analyst community has upped the probability of recession and brought down their targets for the S&P 500. And I think it would be foolish to not think that the probabilities of a recession have increased. That would just be, in my opinion, delusional to not think that recession probabilities have increased. Tariffs massively disrupt what's happening. But you might say, but Nick, you're bullish on the market and yet you think a recession probability increased? Absolutely. The needle has moved. The game has changed, right? The market, in my opinion, has properly reflected that increased probability of recession. So you might say, well, Nick, recession probabilities have spiked. More likely are we going to see a recession? I would say, well, yeah, the market's already figured that out. That's why it's down so much. That's why it's already down. So analysts actually, by the way, too, a fascinating indicator is that when analysts all move their price targets down, historically, that's actually been a better time to buy stocks. The reason for that is not being delusional, but simply put, it goes along the same idea that we discuss with our sentiment indicators. Analysts are humans too. When everybody gets bearish and is convinced, oh, yep. You know what happened in 2022? In 2022, the analyst community put a 100% chance of a recession happening in, notoriously, 100% chance of a recession in 2023. Biden inflation's going to ruin us. Bidenomics, world's going to end. Stocks sold off amazingly in 2022. No recession. 100% chance, no recession. Now, there could be a recession. I'm not saying, I'm not wagging my finger in the face of recession and saying no chance. There is a chance. That's why the market went down quite a bit. But when we get headlines that progress is being made in any sort of negotiations, guess what happens? That recession probability drops by 10% real quick, or 20% or whatever. So I think you have to be careful. You get those headlines. By the time you've gotten those headlines, their research teams, the hedge fund community, they've already sold, right? They've already sold out. So you getting that news, you have to be careful with that, because again, you are getting that news after they've seen a big sell-off in the market and they're revising their numbers lower. I don't think it's worth completely ignoring analysts, but I think you have to take everything analysts in the community and news stations, you have to take stuff with a grain of salt, because I listen to a lot of television in the financial space. And what I can tell you is, like, 9 out of 10 people you hear from right now, they flipped bearish. You know what? Right here, 9 out of 10 of them were bullish. Actually, like 10 out of 10 of them were bullish. Everybody was bullish at the top. Trump's, low regulation, low taxes, going to send us into a new paradigm of bullishness. People do this. They get overbought and oversold in terms of their analysis. So I just think you got to be careful. I mean, look at this. Everybody was so bared up, and look at what we are seeing in front of our eyes. The Nasdaq's up, you ready? 4.4% in a day. It's just incredible, like, what you see occurring right now. Just incredible. There must have been further news. Anybody got what's the latest headline? Because that, yes, here we go. Ready for it? The South Korean acting president said, we will not band together with China, Japan to counter U.S. tariffs, according to CNN. Trump also says here, China also wants to make a deal badly. So there you go. Again, it's one headline away and the market rips 4% in a day, 4.2% in the day. It's a chaotic market. I think that, people who are, we had a theme yesterday. You need to pay attention to the data because this is what will guide you. This is what will save you in environments like this. If you're chasing headlines, if you're trading off of emotions, if you're just, in a state of panic one day and in a state of greed the next, stop what you're doing. And, there's a lot of people who got really convinced the market's going to crash yesterday, and the market absolutely Hulk slammed higher. If you are on the wrong side of this move today, all I would say is, it's natural to make trading mistakes and to realize, wait a second, I did chase. Nick, you're talking about me. I did that. If that's you, I'm not here trying to shame you, but I'm inviting you to consider taking a step back, a step of humility, and saying, okay, fine. I think I might have made a mistake. I think I might have. You might still be bearish. That's not what I'm saying. Like I said, I'm not saying market can't go lower, but if you chased and truly believe that the market was going to crash yesterday, I'm inviting you to just say, okay, maybe I'm making some of the most beginner made mistakes anyone ever makes. I'm just inviting you to consider sticking around in the stream, because we talk about this stuff. We talk about how to avoid making those very, very controllable mistakes. What are the controllable mistakes? We don't know what the market's going to do. We don't know with certainty if this market's going to roll over and crash or if it's going to rip from new highs. We don't know that. Here's what we do know. What every single one of us watching this and discussing this right now together can do. We can control how much leverage we're using. We can control our position sizing. We can control when we enter the market, when we exit the market. We can control if we have a trading plan. We can control those things. Focus what you can control yourself on. If you are looking at this and you're like, I chased the heck out of this market trying to short, and now my account is in shambles, learn from it. Your account should never be in shambles from a 1 or 2 day move. Never, right? If it is, your position sizing is way too big, and I'm inviting you to learn from it, right? A lot of people lose a lot of money in the markets every single day. Recently, people have lost a lot more, because when you get these kinds of moves, they're very, very devastating for some, and other people are running on a high and then they lose it the next day. Slow it down. I'm telling you, slow it down. Start paying attention to these tools. Don't ignore sentiment. It's a powerful, powerful thing that has guided us who have been watching these streams and discussing this together in the comment section. This has guided us. Put to call ratio, AAII investor sentiment, Bitcoin to gold ratio, put to call ratio, COT data. This has helped guide us through this. If you don't have access to the Edge Finder and you want to take advantage of our sale of the year that we're doing right now, it is currently 40% off. You can get 40% off the Edge Finder for a very limited time. It's our biggest discount of the year since we launched these tools. And from personal, I'm never going to guarantee you, oh, you buy the Edge Finder, you're going to make a whole bunch of money. But I can tell you genuinely, Edge Finder has saved me probably $100,000 in this recent move. Just paying attention to the data, okay? The right tools, the right insights, the right risk management. You can still be wrong and survive. That is the key, okay? People are going to make money in this, or at least live through this. They're focused on survival. People who are chasing a big move and making a lot of money one day and then giving it back the next, they're going to blow up in the end. Don't be one of those people. Trade with data. Focus on economic reports, economic data, sentiment tools. Focus on this stuff and stop reading CNN, Bloomberg, Fox. Stop reading that. That's not going to help you. Okay? Those headlines cause jolts in the markets, but you can read those things and get a fully incorrect, biased view of the market just based on who you're reading it from. You read it from Fox, oh, I'm going to take this perspective. Read it from CNN, oh, I'm going to take this perspective. Just, again, focus on the data, focus on what you can control, and keep an eye. Keep an eye open on what we can control and stay in focus. Like I said, if you want access to the Edge Finder, send us a direct message here. You get some information about the Edge Finder. We're currently running, like I said, our biggest discount of the entire year. Click that link. You can also, if you're watching on a TV or some other place, head over to a1trading.com. You can also explore the Edge Finder if you just want to check out its features. Feel free to go to a1trading.com, Edge Finder tutorials right here. See that? Or just head over to a1trading.com/Edge Finder. And like I said, do not miss the anniversary sale. It is the biggest one that we do all year long. Price does not get any lower than that. Are you a Fox hater? No, I don't. I really don't watch CNN or Fox. The only ones that I watch for work purposes really are Bloomberg and CNBC. Nick is slapping truth like a bass guitar. Man, I have a passion for this topic like no other because look, I'm not a saint. Like I'm here selling a product. Like I sell the Edge Finder. I'm not here. Take everything I say with a grain of salt. Don't trust anybody. Don't trust, verify, right? Or trust but verify. What's the expression? But I show you guys real accounts. I do my best to be transparent and real. This has not been an easy time. I've given back. This crazy move to the upside is just gaining back some of the losses this month. Ready? At one point, I was down $75,000 in this account. $75,000 this month. Okay? So there's some transparency, right? Market sell-offs are no joke. But I've been through them before. I know what to do. Stick to the system. I know that I'll be fine in the end. I'm not leveraged. I'm not all in. I've been prepared for a move like this. And I'm playing the game that I know how to play, which is slow and steady wins the race. I'm telling you, a lot of people are going to blow up. If you're on the same wavelength as me, subscribe. But I have a passion for this topic because I'm telling you from personal experience as a YouTube creator in the trading space, I have countless messages of people who have really lost a lot of money in the markets. And that hurts my soul, to read those messages. Nick, I've lost $25,000. I lost my family's inheritance money. Horrible stuff. Like I know this is no joke for a lot of people, especially times like this. This is where I get especially amped up on this stuff, is because I know there's going to be somebody who listens this today. And if I can positively impact that person to reconsider what risks they're taking that they may not be aware of, I know I could potentially save someone's trading journey or investing journey. And God forbid, maybe save someone's, whole life. Okay. Not me, but just having this conversation might encourage people to look into what they're doing and be more careful, because this stuff is no joke. Okay. So that's why I'm so passionate about this topic. Like I said, I'm not a saint. I sell stuff on my stuff. I have a tool here for sale. I'm actively looking to sell copies of something that I think is very worth having. So I'm not here just doing this as a charity or out of the goodness of my soul, but this topic is very important to me because I know that a lot of people get really hurt in this stuff. And if I can help people get, at least get people thinking about what they're doing, about their risk management, about what their view on the markets is, if I can make that impact on somebody, I'll feel very much like I did something good. But you guys know who I'm talking about. Like there's a lot of people out there. You've probably seen comments too. People like, I'm devastated. I've lost countless amounts of money, treating trading like a casino. And that's the issue with trading, is that it's so accessible to people. And many people do end up treating it like a roulette table. My goodness, guys, NASDAQ up just crazy today. 4.3%. S&P is up 3.4%. Gold's up 1%. Silver's up 1.2. Understanding human psychology is really important in investing. It really is. Appreciate you, Jonathan. And to those of you guys who have been, supportive during this time on my channel, I do appreciate that too. There's a lot of negativity that comes my way if I can rant for just a second or vent to you guys. When I have these types of market environments, the comment section typically gets pretty ugly because obviously people who are bearish, who may, be in a really unstable mental place or like all in short or something like that, and a move like this, really crushes them. They come to YouTube comments and they're very upset. They're really angry, not necessarily at me, but I end up becoming a punching bag for some people. So I appreciate people who have also been very kind and supportive during this time. And I do hope that you're doing okay in all of this craziness. It is a crazy market. Down about 15 to 20%. Can I ask you guys, if anybody wants to be very transparent with the class here, let us know what your portfolio is doing year to date. 15 to 20%. That is a drawdown. But again, you have to think about like, look at what you're doing and say, if you're down 15 to 20, let me show you where I'm at. I'll show you guys exactly where I'm at year to date. Hold on. Here we go. So year to date, I am down 3.28%, $35,000. And on a percentage basis, my portfolio is down 3.3%. Now, granted, a lot of that bounce back is occurring today. But understand, if you are doing better than minus 15%, the NASDAQ yesterday was down 20% at one point. If you're doing better than down 15%, what's the S&P? This is the benchmark I really use. So now S&P was down at one point more than 14%. This is year to date, by the way. Down 10.5, like down 3.4%. I'm pretty thrilled with that, all things considered. I'm down a lot of money, don't get me wrong, but on a percentage basis relative to the S&P, I'm feeling okay. Okay, guys, coming up next, we're going to bring in Chris Pulver. Him and I have been super busy in our VIP group. If you are not inside of the VIP group or you don't have access to the Edge Finder and you'd like to take your trading to the next level, stop messing around, stop running in circles out there. I know how difficult it is to find people who will show you something like I just did. Okay. I will show you guys my portfolio all the time, up or down, rain or shine. I've lost 35 grand. I don't care. I'll show you guys. This is my channel. This is what I do. Right. Same thing with Chris Pulver. We are as transparent as it gets when it comes to trading. Chris has been doing this a lot longer than me. So stick around and learn something from him for free on this YouTube channel, or consider taking it to the next level. Get access to our tools, track institutional positioning with the Edge Finder or the put to call ratio. Start using the tools that we use, or consider joining us inside of the VIP Discord. For either one, we'll drop a link here in the chat. You can send us a direct message using that, or head over to a1trading.com and use the live chat feature in the bottom right. Chris Pulver's taken over the show. Again, a veteran trader who also shares real broker statements and all that sort of good stuff. And I hope that you take that as seriously as we do, as it helps the audience know you're not wasting your time watching somebody who doesn't have real skin in the game. With that said, stay tuned. We'll be right back with Chris Pulver just after this quick break.
Hey everybody, thanks for tuning in to today's A1 trading session. We love engaging with our audience, talking shop, taking requests, and sharing our favorite setups. It's about that time where we're going to review a bunch of indexes, stocks, currencies, gold, silver, Bitcoin, and pretty much anything else, and share our insights. If you're wondering what trades I'm in, if you're wondering what trades I'm taking, and you'd like to see exactly how I'm trading everything, you can actually follow my trading signals. If that sounds like something you're interested in, we'll share a link in the chat and you can sign up. You can sign up directly with the link or speak to a support rep if you have any questions. If you're asking, what do I trade? Pretty much everything. Indexes, ETFs, stocks, options, futures, Forex, and crypto. Thoughtful analysis, active trading. Check it out. And now, back to the show. Good morning, everybody. Happy Tuesday. It certainly feels a little bit better today than it has been the last 3-4 days. Pretty wild swings yesterday. Just to put it in perspective, we had a percentage move intraday from a close Friday a gap down of about 4.5%. So we gapped lower about 3%, pushed another 1.6%. So we had from close Friday to low Monday, 4.62%. That was kind of the extent of what this near-term pain has felt like. Then we had a rally of 8.55% intraday that then ended up settling right back into the middle, and it basically finished completely flat. Crazy kind of shakeout type day. IV was incredibly high. I took some more bites and nibbles. I added some trades into the pulver alerts. Those trades include a trade. Excuse me one second. Let me go down to my tracker here. So includes a trade on IWM, Micron, Apple, Nvidia, Google, SPY, Delta Airlines. TLT, I'm a little kind of annoyed with. I didn't do anything other than roll my calls out, and I tried to roll them up. I still think TLT looks fairly bullish towards the 100 handle. But in this near-term equity rally, it's not a surprise we're seeing a dip in bonds and a rally in equities just as a little relief rally. And I also have some puts, SPY and Qs. This was for my margin accounts. I did some naked puts, 435 put on the SPY and a 365 put on the Qs. Right now, each one of those are up around 50% within like a week. So that was the nice thing about selling premium. It looks like this. I'll go back to SPX in just a second here, but here's the VIX. VIX was all the way up towards 60 yesterday. That was the high of the day. And then we just aggressively faded off of that. So VIX, naturally a reverting instrument. I wasn't, sure. Obviously, nobody was like when the VIX was going to stop. This was like the third largest spike at all time. I think this is the third largest. I can confirm that here, but give me one sec. Let's go. Pretty sure this is at least top 5 VIX, but we're talking like crazy crisis levels that we've seen in the past. But there's always something else. Like there's always some other extreme in the market. You never know. Okay, so we are officially now the worst performance through the first 65 trading days. It is 5th all-time worst for the first 65 trading days of the year. Congratulations. If you can survive 2025, you just survived the fifth worst start in the first 65 days of trading. What else do we have here? Roughs, recessions. Oh yeah. I talked about this yesterday in class. Biggest 3-day spikes. There you go. So the biggest 3-day VIX spikes since 1990. It is 5th and 6th all time. Biggest spikes in the VIX. Impressive. One indicator that I've been mentioning for the last couple of months would be looking at your S&P above the 50-day moving average. Right here, I've taken some nibbles. That's all it is. I don't think the lows are in necessarily. I think there's still some more pain and uncertainty ahead, but a relief rally certainly feels pretty good. For maybe the next, couple of weeks. I think this little cycle between like March expiration and April expiration might offer a bit of a kind of corrective window. So we had like all of the interim like tariff tantrum pain priced in. That's what, yesterday's wild price action was. But this to me offers up a little bit of a bargain. If you wanted to go short-term long the S&P, it's a pretty good time to do it. The last time it was this low would have been the bottom in 2023 after that August-September pullback to around 8 to 10%. And before that would have been the summer and fall bottom, which was the bottom. This September bottom in 2022 was the bottom of the market. So before that, bottom in 2020, that's a COVID bottom. Bottom before that would have been Volmageddon in the end of 2018 when the Fed raised that 4th time, the market crashed, and December 2018, the Fed kicked right back in after a 20% correction, and another good time to be buying stocks. And we melted up to all-time highs all over again. So you don't see this very often. This is why I angled my portfolio at least short-term long, and seeing the benefits of that today. So I've got some trades in on SPY, QQQ, some naked puts, like I said, selling some high premium. I'm not necessarily looking to hold those all the way to expiration. Some of those expirations are out into May, out into June. But if I'm at 50, 60, 70% profit on those trades, I don't need to worry about the gamma risk towards the expiration of those options. I'm just going to take a majority of the profit, move on, and get the buying power back. So let me have a quick look. Up on the day, I mean, obviously P&L's had a huge swing. Right now we're, sharing, you show me mine, I show you yours. And, my portfolio is still red for the year, but certainly doing a lot better. So 67, 67K-ish floating out of the total to the start. So I'm down 2.3% for the year, but I'm still sitting on, hedge profits and positions that just need time to work, position levels that aren't necessarily threatened. It's just been a big change in volatility, and that has made option prices go wild and crazy. So Tesla back up above 248. It shows here that I'm down, 26K on Tesla, when the reality is if we stay above 247.50, I'm going to make like $8,000 on Tesla this week. So it's just option prices have to settle down. If we can stay above 247.50, I'm not going to get cute with this. I'm just going to let it get called away. I'm not going to roll it. I'll take the income trade. I sold some premium on Tesla. I still have some ratio spreads running with out into May, so those aren't threatened just quite yet. Let's go to those naked puts for a second. So here is a put on the Qs. I think I did a put on the Dow as well. Let me double check that. So Dow, I did a 1111 trade, so that's a 360 on the Dow. That's currently down about $900, but that trade, we'd have to see the Dow drop another 10% for my position to be in jeopardy. And that trade is good for a $550 winner. So is that what I did here? Buy. So I did a 112. Okay, so I'm selling. That's why. But this is only out to June. I'll keep a close eye on this, but we'd have to drop another. Yeah, we'd have to drop basically 10% on the Dow in order for this trade to be threatened. Not that it can't, but I still collected some pretty high premium in some of these recent moves to the downside. Let's go Qs. So I have a put that is up around $100 right now. A trade right here that is already up $126 just in the last 24 hours. So this trade's up 22% real quick. Going after like a 30 to 40% winner in this one. Keep an eye on those. And then SPY, my put. This is just a naked put. Is that one grouped? Hang on a second. SMH, that one's looking fine. This one is ungrouped. So this group, there we go, naked put. Okay, so this is, there we go. So it's getting these labeled. So looking at profit there, naked put for 435, already up some bucks. Naked put for 460. This one's taking on a little bit of heat, but I'm okay with it right now. I collected 423. And this is an example. Like I collected $4 and change on a 460 put. We're trading at 524. I'm 60 points clear of this. What was the low on the SPY? I don't think the low was 460. The low was around 480, right? So we'd have to revisit this low by, I guess, June, which is possible. But I'm also not. I'm not opposed to taking ownership and shares of the SPY with this account, which has $250,000. If I bought 100 shares at 460, I can allocate that and take a chunk of shares and repair it. So anyway, point is, a lot of trading going on. This will be a living, breathing P&L cycle. My goal is to get back to the yearly highs, which my yearly highs were around 205K. And that was after the March decline. So we had the March decline, had that little 2-week rally. I was at 205K right there. So now that we are dramatically lower than that, I'm hoping for a little relief rally. I'm curious to see how close I can get back to those all-time highs again and still be better positioned for, all-time highs, no problem, if we get back to all-time highs. However, I don't think that this market is just done going down. Earnings season is kicking off on Friday. It starts with the banks. So this is what the earnings calendar looks like. It's not super busy. I mean, we only have, I'd say 20, 30 notable names this week. But Delta, which has had a monster decline of about 50% since the all-time highs. And then we start out with Friday, what's going to be kind of the big guidance for Q1. JP Morgan, BlackRock, Wells Fargo, BNY, Morgan Stanley, their guidance / comments will be interesting. If they, just talk, hey, these are the numbers, earnings per shares, revenue, our consumer. I mean, I don't know. I have a feeling they're maybe going to say something tariff related, maybe talk about the current environment and uncertainty. But If they wanted to do kind of a solid for the overall market, then they should probably keep it pretty neutral, if not somewhat optimistic, if they even are. Look, I think that what the banks went through in 2008, that they are more battle tested and prepared to prevent a 2008 from happening again. Not saying that it can't in some different way. But point is, I mean, it kind of sucks to have to report earnings right now, right? After dealing with what is almost like a systemic risk to the markets, but you see the intercorrelation, you see the connectedness, and you see the volatility, and you see how quickly the market can just go into like straight fear mode. Um, it is irrational. I mean, you can't think your way like, oh, that made sense. I mean, the only thing that made sense this year to me, and again, this is all from a technical standpoint, is we had a correction in the 200 moving average and we paused there, and all this was a measurement. It's not that difficult to measure this move. Watch. So if you go from high to low, okay, and you measure this move to the downside, that's pretty darn good. I will do that again if you missed it. It's kind of like a magic trick. But a cup and handle pattern, which is the market drops aggressively, pauses. The way you measure that move is you box this high to low in, and then you measure that breakout move. Okay. And watch how pretty perfect that box is. Here is the high to low swing right here. Okay. And then watch the breakout point. I'm just going to copy and paste this. Boom. Copy and paste, put it right at the breakout point, and look at where the market bottomed. Right there. That is why at the 490, 485, 480 level, I was looking out of the money, high implied volatility, selling puts, right? Doing bull put spreads. I mean, they're out of the money, but I was getting, $4, $5, $6, $7 on some of those puts for a probability that IV is not going to continue to get higher, and you could go way outside of the expected range for what is lining up to be a pretty safe trade over like a 45 to 60 day window. So the market, from a technical standpoint, did pretty darn well, despite how nasty it felt. It was destination technicals. It just happened to do it in 3 days. So it's not like this market wasn't forecasted or measured ahead of time. And if you've been following the stream for the last month or so, once we had this push down to like 550, I said this area is vulnerable. If we break below this level, there's nothing stopping it. Don't think about this level or this level. Nothing stopping this until that previous all-time high. And where do we come to? Previous all-time high. Like, even though this was a crazy, scary sell-off and we hit that 20%, peak to trough, it still was findable, right? And here we are, off those lows. Like, that's a pretty solid reaction to that, right? So anyway, I just, let's keep this like really simple, because the bigger fib level that I'm watching, we also pulled back to right around the 50% zone. So you take this previous swing here from the lows in October 2022 after that bear market low, and I'm still like, I still kind of agree this. I think there's going to be some trouble ahead here now that we have flirted with this previous high. But the nice thing is as long as this isn't like a deep recession systemic risk that brings us into open space this way, that would be like way more concerning. Okay. If the market can maintain protection around that level, this could be kind of our chop fest in here. And I think that's okay. I think we can survive in there. Just don't do anything crazy. But if this is a wave 1, 2, 3, we had our pullback for wave 4. I still wonder if it's possible that this whole thing with tariffs settle in, show some U.S. economy resiliency, as long as U.S. job numbers don't start to trend aggressively higher by September, October, November, December. And the reason that's the window I'm watching so closely on jobs is because all of the federal government layoffs are not really going to hit the tape until September or after. And if those workers don't find jobs in the private sector, that's going to start popping up in our jobless claims, initial jobless claims, continued jobless claims. And that unemployment rate goes from a 4.1 to what the Fed is forecasted by the end of the year, around 4.5%. That's a big jump. I don't think there would be any type of intervention by the Fed until maybe this spikes up into the high 4s, maybe even 5%. I don't think there's any intervention from the Fed unless we are down to maybe 4,000 and having like maybe a 30% dip from the all-time highs. So this idea of like the Fed put or the Trump put, I mean, I don't think there is a Trump put as far as if all the administration is thinking about is trying to play hardball with this tariff stuff. I don't think there's a Trump put. I mean, clearly his approval ratings have dipped hard. Narrative isn't changing. Fine, but the Fed put is still lower. The price to earnings S&P, we're at 19 right now. Usually when the market finds a true bottom, we're trading around like a 17 or 16. Unfortunately, that's a little bit lower. That's like a 4,500 S&P. That's a 4,250 S&P. And I don't know how that settles in, but we're going to find out. Okay. All right. So anyway, fib wise, we hit a 50% pullback zone, previous all-time highs in the 2021-2022 peak. That's exactly where the market pulled back to, and you can see that measured move from the high-low breakout point, like a big bear flag. And now the market's up. And from the lows from yesterday, it's like that's a big swing, by the way. In 2 days, you saw a bottom to move. I mean, that's an 8.7% swing in 2 days. So am I super stoked and excited about the market showing 3.79%? It's certainly better than being red. But I think this is a relief rally, and the Bears are still going to have their chance to claw back a little bit. Where would I be watching? It's here. Anywhere at this gap fill or anywhere at this past support becoming resistance or even the 200 moving average. Any relief rally that gets us up into this area, I'm going to look for some shorts or some shorts or some shorts. Those obviously aren't perfect, but trading options, I can probably give myself like a 30, 60, 90-day window to have some of those shorts reposition with much lower volatility so that the puts will be a little bit cheaper, which is good because even down here, buying an out-of-the-money put was pretty expensive. And granted, the market was gapping lower, and those paid pretty well, but I was still paying somewhere into $4, $5, $6 for a long put. That was out of the money, by the way. Okay. Out of curiosity, you just copy and paste it, calling the bottom. I mean, yeah, it's just a breakout move. I mean, it's essentially like a cup and handle, but just inverse. So a cup and handle. I actually know that is the cup and handle pattern. The inverse cup and handle would be bullish move, and then a pause, and then a rip higher. Right. So I mean, what's wouldn't be surprising is if we have this rip here, and then we pause and we have a inverse cup and handle that does the exact same thing. And maybe this comes right back to the 200 moving average. And the bulls are, feeling better. The bears maybe come back in for a swing, but we might protect this low, and this market might not break highs, not break lows, and we just kind of grind through this 20%, peak to trough that we're going to have to trade in between. I think for the market to get to all-time highs, we've got to justify a lot better fundamental data. We've got to see that companies are resilient with earnings. We're going to have to see that the Fed is going to stay on pace for cutting rates this year. I think that will help the Russell more than anything, which is clearly in a bear market at 20+%, even though the Russell's ripping up higher today. So anyway, cup and handle is what I'm looking at. You can search the patterns, you can see how they're measured, but it's pretty straightforward. You have a high to low, and then a little pause. Okay, and I call this more of a cup and handle versus a flag because usually flags aren't monster patterns, but a high-low pullback like this, okay, that type of pullback, just measure the move. Well, I can just draw it out here. So you measure this move here, make it a little bit thicker. You measure that move from the high-low swing, and you can just measure the breakout point. And that's usually about where the market, finishes the move. It's technically fulfilled, and there's usually a bounce. So yeah, just good old technicals. All right, that's SPX. Let's go to some other top downs. So everything's looking green today. That's super encouraging. I'll continue to watch, for the day. I've got some expirations to comb through here. So I have a couple of trades running this morning for 0 DTE. I closed out a couple already, have some profits. This one is 40 by 25. That's a ungroup. Another bull put by the end of the day. So that one for 65 cents. That one for 90 cents. Hopefully those continue to run for some more profit on the day. I'm probably going to take a loss on XSP. That was I took some nice chunks of profit on like 16 winners on XSP, but I'm going to take a couple losses, and those are going to stack up, which will suck. Maybe, but it's by this. I've got one that's going to be a small loss by Friday, and then I've got other ones out into late April and also May. We'll see how those play out. Tesla, like I said, staying above 247.50 this week. I will. I mean, like I'm saying, I'm showing 26K down because the volatility has been so big on Tesla, but I get it called away this week for like an $8,000 winner. So if it stays above 247.50, that's profit and a bunch of buying power back. Nasdaq, some puts, some combos. Damn it, man! I'd like close out my effing shares. I put this trade in yesterday to let me hang on a second. Qs. I closed out my long puts and it just didn't fill. Like, what the fudge? This one closed out. This one closed out. Okay, let me try this again. So I was assigned, it was a weird assignment that I had. This position is fine. This one, no shares. Yeah, this is fine. So I've got a 490 by 430 still running. That's a bull call spread still running. Let me separate this one. Okay, and then a put. So I'll be watching that one. It looks like a couple of these didn't close out for my. So this one didn't close out. I still have it pending. What the fudge, dude? So I was assigned at 530. I've got a put on for 535. I'm trying to close both of these out at 535. I actually wonder right now if I close this thing out, I'm still taking on a small loss there. Signed at 530. I mean, it's trading at 534.99. Like, I think if I go unfavorable, let me see if I go 98, 97. Yeah, I mean, I need to close this out at my long put level in order to give me I just don't want to tie up the buying power. So I suppose I could eat like the extra $50 loss if I just close it out right now. Let me see here. Let me see if I can get this for 534.90. Yep, so it says unfavorable. That's what I thought. That's what I was doing before. So let me take like 5 cents more. All right, I just gotta let that one marinate. I'm gonna modify this and just take on just a little bit smaller. It shouldn't be this way. I should be able to close this thing out for like 534.99. I'll take the 5 cent hit. That's fine, but I shouldn't have to take this much like width in my bid mid ask. So I'm gonna go 534.95. Okay, this one's fine. This one's fine. This one's fine. This one's fine. This one too. So 534.95. All right, I'll let those go. Those should get filled today. Should be able to get some buying power back. Same thing here. Okay, watching those. That might be the last one. Q's just partial. Bull call. Bull call. All right. All right, we'll go top down. I just want to get through a couple of those things. Oops, not a close. There we go. So they're just getting filled now, getting the buying power back. Beautiful. All right, that's good. All right. Dollar index still pulling back. We also saw some flash crashes in the currency world. So big spikes on Swiss, big spikes on Japanese yen, big spikes on dollar. Currency strength chart not working for some reason. There we go. And I don't have any screenshots from the last couple of days, but basically when we started to see super high volatility, it was stronger Swiss, stronger Japanese yen. The dollar was beat up really badly and then pivoted harder on that one-on-one handle. Right now, things are a little bit quieter for the day, but it's a risk-on day. So Aussie, New Zealand making a big comeback. I got filled on a 60-20 buy trade on the Aussie dollar. That was a pending order from a while back. I'm going to ride that one out a little bit longer. I'm still long on the Swiss. I just lowered my cost basis because I had some scale in levels. I'm still just sitting on some positive swap for the most part between the accounts I'm trading. I've still collected a solid like 3 to 4% on currencies. It's just now it's okay. Well, my break even is a little bit worse, but I'm slowly working costs lower. I just have to be patient, and I'll still be patient. But eventually, I'll be working through those Swiss pairs. It'll be fine. So here's today. I mean, decent amount of volatility. New Zealand, Aussie on top, dollar weaker. Things kind of hanging out at baseline. No real outliers outside the Aussie, New Zealand. Take a look at oil. Had a good conversation yesterday. I think $60. Be careful of shorting oil because below $60, things get a little nasty. Where basically below $60, most producers, it's unprofitable. It's mostly unprofitable. If we're below $60 a barrel right now, it's unprofitable to be producing oil. The U.S. can get away with it, but they don't love margins. I mean, I'm pretty sure the U.S. right now could probably produce oil if needed in like the mid 30s. Saudi Arabia, same thing, mid 30s. And that was kind of this big push is trying to get oil prices down in order to maintain market share, but it's not super profitable. It would just basically squeeze the producers that can't be profitable. And, that's why we have wars. So anyway, I think this initial break it could be an overreaction maybe, but I'm just trying to stay out. I mean, this is the type of silly move that busted up a lot of traders. I know a lot of good traders that unfortunately they sell a bunch of premium, but they do it both ways. And a big kind of 2-3 standard deviation move like that will just bust up those trades. And that is why I continue to preach just trade like risk defined. I like if you want to do a strangle and if you wanted to sell a call and buy a call or I'm sorry, sell a call, sell a put, that's fine. But a 2 to 3 standard deviation move will completely F up your trade. So I would rather do a smaller credit, define risk, and take the same trade, but never let a outlier type move make this worse than what it already is initially. So I think smaller trade, smaller risk is better. Natural gas, we are retreating, but I'm still long in this through 2027. So I'm probably just going to roll my calls down or roll them out. I'm in for this all like break evens around 16.25. I wouldn't mind looking at like a 20 for income. Maybe a 20 or 21 if I go at another 30 to 40 days. Let me see what that UNG is trading for right now. So UNG, I've got 91.4% of that covered call or that sell call in profit already. I could just roll it. I mean, it's worth an extra 6 cents for the next 9 days, or I can just roll it and start this process over. So I'll probably end up rolling that. Uber had a big swing. I've got it's a 1-1-2 trade. So I bought a put, sold 2 puts. So it's a bear put spread for $2.50 and then 2 puts at $60. That one is out to May. I'm just going to hang in there. That's I think that's through earnings or before earnings. Let me double check on Uber. Uber earnings will be April 30th. So I'll have to take that trade through earnings. All right, let's go back to oil. Gold. I'm sure there's some traders that bought the dip on gold. I know a lot of people are liking like, okay, my 50 period moving average, 29.50. Okay, that's fine. I still am not ready for gold to be long unless I hopefully see a deeper pullback. So I mean, again, and call me picky, right? But if gold wants to keep going higher and higher and higher, that's fine. I'm still running with shares of GLD. That's fine. If we have this period offering some consolidation, maybe the bulls just take a freaking breather here and this stretch away move, like we had a correction here when it got stretched away pretty far. We had a correction here when it got stretched away pretty far. I could see gold, not just returning to all-time highs, but rather facing some form of consolidation, letting some of these moving averages catch up a little bit, right? And then any move like this that offers a dip at the 200, sure, I'd like to, I just want to see that 200 offer dynamic support. It's been 380 bars, and I think that is a valid bar count plus the stretch away move of nearly 20%. This is why I'm not crazy bullish right now. It's like I'm just going to hold positions. We stay further and further away from it. That's fine. But to me, I'm a lot more excited about balancing this buy zone and trying to buy some dips that are hopefully pretty meaningful. That would be this previous high right here. That would be this 144 to 200 moving average. So if we find those, I'm a lot happier as a buyer. If we consolidate, that's okay, but not great. I'm just consolidation. I'm just going to hang on there and hold. Okay. Silver's making a nice little comeback. Still a long ways off. I mean, silver's performance was crap compared to gold. Silver was down 18% in 3-4 days of trading. And right here, 6.5. Wow, that's so different. Gold was down 6.5%, while silver was down 18% from high to low. That's not even close. And that makes me think that this XAU XAG chart has broken to the upside. Wow, by a lot. Not even close. So, massive breakout. What was a pretty solid range between gold and silver. Now gold is just getting the huge bid. So again, that could quickly change. I mean, we could see this come back in. Maybe this new range establishes itself. I don't mind either one, but gold is clearly getting the nod as like a little bit more safe haven, a little bit more store value, a little bit more of an asset investment versus silver is like poor man's gold. And this whole idea of like global slowdown, look no further than copper. Okay, copper, not there yet, but copper is. Thanks for grabbing that question, Nick. Yeah, I was gonna say, I mean, I don't make any money on YouTube. I mean, I have like my personal channel is like 9,000 subscribers. I, make nothing on YouTube. I don't do it for money. It's like YouTube is I quickly realized that YouTube for me in my start is like, it's more of a creative outlet. It's more of a passion project, more of a, hey, it's trust content. And if you want to, trade with me live, then I've got services and other things that I run, similar to what, it's like Edge Finder and Pulver Alerts and things like that. It's like I trade. So there's my income source. Copper, we're at 4.20. And this really sucks, but in the next 16 days, I'd like to see if copper can stay above this level. Now, I do have a profit trap here between the four. I did a 111, so I do have defined risk on this one. I'm hoping that we stay above, right? I hope we stay above, but if we stay above 4.18, 4.18 on copper is kind of perfect because that would be an extra profit trap. So if I go into my copper trade here, there it is. So copper here, 1111. So here's the trade. If I can zoom in, let me. All right, it's not the greatest zoom in, but you get the idea. So we're trading around 4.21 right now. I do have a profit trap, so even if we go up on copper, that's good for the next like 16 days. If we continue to go down on copper, it's okay because I actually have a slightly bigger profit trap there. So this is 175. I mean, why am I not showing the profit trap here? There's got to be like an extra $100 or so. Okay, max loss is 1,500. Max profit should be 275 versus whatever. I'll figure it out. If we go up, it's fine. I'll still make the 160 on the trade. I got a little profit trap there of should be $1. but I'll keep an eye on that little profit trap. All right, back to silver. Bitcoin, we're at 78K. Again, key level on Bitcoin is 75. We shouldn't do too much damage below that. As long as we're not really doing any aggressive closes below 70,000, I think Bitcoin is still pretty good. A lot of Bitcoin enthusiasts were all excited that, Bitcoin is decoupling from the S&P. Maybe. Is it though? I don't know. Because the S&P is up 4% today and Bitcoin's down. So, I don't know. I mean, I still think there's just this whole window. It's like you've got BlackRock is probably the biggest resiliency in Bitcoin to me since it's been securitized, and you've got IBIT and all your approved ETFs. Price action is definitely a little bit quieter, not nearly as volatile, but from a technical standpoint, this resistance is going to be key, right? If this resistance holds and offers support, that is good. If we stay above this 74, 75K mark and start getting on the right-hand side of the trend line, that would be an encouraging sign for Bitcoin and some risk on to happen. But, like I said, the conversations were swirling over the weekend of, it's decoupled and this is how it all changes and the whole market's interconnected, but Bitcoin's not. I don't really believe that. I think that basically it's like everyone holds Bitcoin, right? And so that's what it shows me, is that now that there's allocations in and people are holding Bitcoin, they're just not selling. So it's not panic selling. Maybe it's more of the allocation of Bitcoin. So if you have a 1% allocation, you don't need to sell your Bitcoin. Ride your 1% out, right? So I mean, I just wonder if like the I don't know, the shitcoin crowd is gone. The pump and dump crowd is gone. The bull market geniuses are gone. Like the market we just experienced the last 2, 3, 4 weeks will make a lot of people disappear. Like it will flush out all the leveraged, over leveraged, silly traders that only make money in bull markets, have no idea how to prepare for a downturn, and obviously don't stay solvent when it does happen. So, but I'm curious on the allocation side if this is just, look, you're going to hold through it. It's a tiny allocation, you hold through it, and that might be contributing to why this has shown some resiliency, as opposed to it's this big dirty secret that nobody knows. It's like, I mean, I think it's pretty clear that BlackRock is one of the biggest asset managers in the world with like $3 or $4 trillion under management. I'm pretty sure that they have some high net worth clients and institutions that are holding some stake in their portfolio of Bitcoin, and whether it's just IBIT or it's actually trading through some exchange. But a 1% allocation is not that big of a deal. Like, look, if I ever lost 1% of my account, could I make it up? Absolutely. I'm personally a little bit more invested. I've got clients in for about 3 to 5% Bitcoin. Personally, I'm into like about a 10% window in Bitcoin for risk capital. But again, it's been nice to see it somewhat resilient. That's all. Okay, so we'll see. Just keep an eye on it. But like I said, I don't want to see it break too much lower than like 74K. $70,000 shouldn't be breaking 70,000 if we want to maintain this bull market. MicroStrategy, kind of the same thing, hanging out around that 200 moving average. We could be pretty choppy going back and forth. And here, that volatility could be like $100+ swing. I'm still looking at some income opportunities. I've got my collar trade. That's a 310 by 240, and just watching, see how it plays out. We're back down to the opening gap levels today. Let's see how price plays out for the morning. I'm just watching this right here. So we're gapped higher, up for the day, back down to flat. See if we just chop around. I'd like to see prices, if we're coming in to fill this gap at all today, I'd like to see it at least bounce back up. Maybe the bulls are a little bit hungrier than the bears today. I'm hoping that's the case. I'm hoping this recovery is not like a gap and fade. If that is the case, then we are certainly in an environment where this is not going to be a friendly bull rally in a bear market, right? Like if this market crashes back down and takes out today's gap, these bears are really aggressive. But if the market can just kind of hang out today and chill the F out for, a day, then this gap looks doable. This pullback into some, Fibonacci levels from this recent decline, we could try to find some of those corrections. I'm trading futures. Have you ever see me halt trading when futures market is 10%? It should be 7, 13, and 20. They usually go in 7% increments. 7, 13, and 20 are the circuit breakers in futures, circuit breakers on the indexes. So I think last week the Russell futures halted at 7%. And they only stop it for like I think it's 15 minutes. And then it's like it just positions build back up and they renew it, and it could be, just because they halt doesn't mean anything good is happening. So if it ever happens where the trading is halted, usually it's going to get loaded back up and resume that direction. So it just kind of gives market makers a chance to get a breather and a break, but they're probably hedging like crazy to make sure they're not going to get exposed to anything worse. But it's a 7, 13, and 20% circuit breaker usually. Okay, let's go back to this. Coinbase 163. I do have a Coinbase trade for April 17th. I need to see if it'll stay above 155. So far, it is right now, and this is another one that shows I'm probably red. So portfolio-wise, let's go Coinbase. So it shows that I'm down about $600. Yeah, I mean, I'm down a little bit, but this trade is out 9 days, which is next Friday. If we're above 155, I'm still making money. We're trading around 163 right now, so I've got some wiggle room. Realistically, if I did take shares of Coinbase, my break-even point would be 155 minus 5 minus 2.25. I'd own shares at 147. I would do a quick cover call at the money to repair that. Probably try to grab, anywhere between like $5 to $10 on a covered call. So that should be an easy repair if I need to take on the ownership. I'd obviously hope it stays above 155 and gives me a nice little, winner of, about $1,000. So 155, we're watching closely. Let me set a chart alarm here. 155, that is my ratio spread. Actually, it's more of a 111 sell put. There. So a little bit of wiggle room right there. I mean, this is the systemic stuff I talked about last week. I mean, the DAX, which was the hang on, got a sneeze coming on. Excuse me. I knew it was coming. The DAX was one of the best stories in 2025. Oh, this big rotation out of the U.S. Well, I said if the U.S. catches a cold, the world catches a flu, and the DAX was down 21%, and this mostly happened in 4 days of trading. So this is a complete reset for the year. Year to date, you're pretty much looking at Europe has been, smashed back to essentially break even. So this is what the year looks like so far. Now, I understand there could be opportunities to still be long Europe, but wow, like really volatile, and I'm less excited about that rotation. I'm still in. I still have some exposure. I'm long FEZ, but I'm just selling premium, and my premium's down to like the low 40s, so I'm okay. Let me see what I have here in FEZ. FEZ is selling puts at 49, 48, 47. So it's down a little bit, but with also that was adjusting for a 20% correction, and we had it. Like this is, let me go to FEZ. We came down to $48. We're back up to 49. If the DAX recovers, then this gets back above, and there's money on those puts. So anyway, like I said, it's just everything changed so quickly that Europe was pretty much squashed back to break even. The FTSE, I mean, man, this just nasty spill from high to low. FTSE was down 15.5%, and most of that happened in about 3 trading days. And structurally, I would say that I like this stock way less. Like I like this the UK 100 way less than what I did when it was sitting up above the 200 moving average and it was above this trend line. Now that we're below this trend line, to me, this is a potential, like this is a halt. If at best this is a halt, meaning if we go high to low and we just spend some time kind of grinding back here, we could pull back to equilibrium, but those bears might drag this thing lower if we have another. If the U.S. stock market starts to go lower, FTSE's probably going with it. DAX and Euro stocks going with it. China possibly going with it. China just reset back to post-COVID lows anyway. So other than like Alibaba, everything else has kind of been reset. It's been pretty ugly. Okay, Argentina pulled back in that 200 moving average. I just need to do a little bit more digging on why do I want to trade Argentina? Well, I know country wise they've had some big reform and that's been helping. It's been one of the this is one of the better country ETFs last year. It was up a ridiculous amount. This is the 12-month. So last year Argentina, probably one of the best 2-year performances we've seen from any country. That was up 49% in 2023 and even better in 2024. Argentina was up 62% in 2024. So it got my attention, but I realized that okay, I was going to be patient waiting for a pullback. Well, I got my pullback. But is this good enough, or is this going to be just one of the many emerging markets that if the U.S. isn't doing well, nobody is. You know, and that's the big fight. And I think all this stuff with China, U.S., April 9th, April 10th, which is tomorrow and Thursday. It's going to be interesting how that news kind of hits the markets as well. Are we gonna claw down and have another fit because it's more tariff uncertainty? Maybe. We obviously put in the low at 20+% between the S&P and the Nasdaq. So if there's more of a tantrum swing, then we could see another claw to the downside. Here's China. So what was looking good for that big rip in September pulled back to some nice fib levels, hit some higher highs. What it do? It gave most of it back. So in the bigger picture, I mean, technically it still looks okay. It looks healthy. I mean, we have lows here and higher lows here. But what's a key level for China? Probably finding some bottoming patterns around this current, I'd say between current prices around 19.9 down to 19,000. If this bottoms out and starts to head higher, that's fine. I don't think China's going to do that without the US. I mean, if we're going to play tit for tat with China, this probably drops and the US probably goes with it. Does one lead the other? Or they're both going to suck. And we're talking, deeper and deeper pullbacks and, the threat of recession and just the markets being down so much. All that's a legitimate threat. Brazil, I was excited about this thing getting above the 200 moving average. It's not. So I'll wait. I'm still long on EWZ and ILF. That's Latin America. But we're a long ways away. This is an emerging market that, again, probably needs to see some resiliency in the U.S. to get better. MAGS was down, I think, over 30% from high to low. 33.5% from high to low. So yesterday was a pretty encouraging sign. I posted this in my Telegram. Yesterday, what is it? Maybe I posted the heat map yesterday. There it is. So I posted the S&P above the 50-day moving average. That was at some fresh lows, the 9%. So I'm taking some bites on the market right now. But Mag 7 was encouraging. You had Nvidia, Amazon, Meta, Google up yesterday. Apple was down, Tesla was down, and Microsoft was down. But because the S&P is so beat up and the Nasdaq is so beat up with those, I mean, this is like, let me show you this level. So we talked about that market breadth indicator, right? Only 7% of all S&P stocks are above the 50-day. That's not very many. Okay, on the Nasdaq, even less. 5% of all stocks in the Nasdaq above the 50-day. Short term, I think that offers a relief rally just because everything is so beat up. No guarantees, obviously, but I'd say within the next 30 to 60 days. And maybe what we have to get through here, and this is what I talked about, maybe this cycle of March expiration to April expiration, which is the 17th, so not this Friday, but next Friday, maybe that's enough to say, okay, we survived the cycle. It's a good opportunity to get long the next cycle because these symbols line up, right? This is so beat up. We're sentiment probably at crazy yearly lows again. So everyone's bearish. Put ratios are crazy high, and the market's sitting here with only about 5% of Nasdaq stocks above their 50-day. It's like everything is beat up. So if you want to buy value, everything's on sale. And it's not a long-term play. I mean, if we get a rally of 3-5%, great. We pull back into some of the technicals that the market created so inefficiently on the way down. Great. But I think this is a good short-term indicator for maybe a April 17 to May 16 cycle. So just throwing it out there, I think this market could be at least having some type of relief rally, but we probably have to get through the pain of the 9th and 10th, which is this week, get through CPI data, PPI data, which is Thursday, Friday as well. And then also on the weekly end on the 17th, that's the big monthly expiration for April. Okay. Anything else? Costco, super choppy. I'd like to see if Costco can come back down to something like this: high, low, lower, high, lower, low. Maybe start taking some bites on Costco. I'd love to see like a split lining up here. Um, I love Costco as a stock. I've had it since I've been a member of Costco for a long time, but I'm not excited about trading options on a $900 stock. So it's just not as fun. Certainly nothing I would say like some of the trades I like to put on where I can collect some premium, not really want to own the stock, but if I did have to own the stock, I can afford to. With this price, I'm like, I'm not going to allocate that much money, for basically a $900 stock. No thanks. Even for a portfolio margin account that's going to tie up like $20,000 to $30,000, and that's just way too big of a chunk. So anyway, if it pulls back, great. If we get a split on Tesla, even better. Otherwise, I'm probably just out of this one for a little bit. I still have Walmart. I'm still trading this one defensively, even though it's been treated like a overvalued retailer. Um, but I still like it. I mean, longer term, I think we still have Walmart in the hundreds. I've got a collar trade in. If it dips lower, I'll watch that. Walmart's forward guidance on on consumers. SPX, what the hell just happened there? Just had a trade fill for something. Oh, I got you. Okay, got another broken wing butterfly at the 5,000 handle today. Okay, so I have 50 cents, 65 cents, and 90 cents still running on the day. Hopefully, price will stay above the 50.45. Yeah, I want to see price stay above 50.45 today. Put a line in the sand here. 50.45. Be generous, please. Horizontal ray 50.45 is right in here. Okay, so I'm going to keep an eye on that level. Hopefully we're not. I mean, if I understand if we're coming down to try to fill this gap today, but it's not going to be good because that is this market can't get to this gap, but we're going to quickly come in and fill this gap. Like I said, hopefully the volatility, like the VIX dropping today, will hopefully prevent some of these big intraday swings. And so even a move that's, oh wow, this dropped 100 plus points. Well, that's fine versus 800 points or whatever the hell the swing was yesterday, 400 some points. Yeah, 413 points yesterday was a monster move. So so far from high to low, we've already had about a 97-point move. On average, if this thing goes back to even a remotely average move, we're looking at about 140 points a day. So that should keep me clear of. I mean, this market have to drop over 200 points for me to be threatened on my positions today. Certainly can happen, but hopefully not. All right, starting to see some market maker levels fill back in around 5150, 5125. Hopefully, we're not going too much lower than 5100. Okay, Walmart, Nike, sold some puts on Nike. This is actually this is like a leap. I mean, I sold a 50, 55.50, and 47.50 out to the end of the year. I know that China, Nike, you're going to have some issues. Retailers, if people are cutting back and stopping their sneakerhead purchases, then yeah, I mean Nike could be a lower, but this is lower than the 2020 COVID low, which I thought that was pretty disruptive to the supply chains. But I guess a trade war is equally as bad, and could get worse, but could also get better. Like the trade war situation, it's so much uncertainty priced in. It came out worse than what the market expected. And now it's just a matter of if US digs its heels in and China digs its heels in. I mean, you've got the immovable object versus the unstoppable force, right? And that's what's going on. So that's not a fun fight. Like you're talking, I mean, if anybody's ever read Ray Dalio or heard anything about the change in world order, like that's what's happening right now. It is literally a fight for number one. The U.S. has been king of the mountain for a long time. It's trying to stay there. China's been playing the long game, which is one thing. That's like the only thing I would say I respect about China is You have absolute power, and if you want to get something done, you can put it in place for the next 10 years and do it every single year, every single year, every single year until it's complete. The US, you have a complete flip flop every 2 to 4 years. If everyone's pissed at Donald Trump and this administration, in 2 years, they're going to show it by flipping the elections, and all of a sudden the House and Senate will be given back to Democrats, and you're going to have a lame duck presidency for the next 2 years after midterms, right? Like I think that's a big problem in the U.S. is one side says this is what we're going to do. We're going to take away everything the previous administration did and do our thing, and then if they lose and the pendulum swings the other way, that administration was the worst thing ever. Terrible things for the economy and in the world. Blah blah blah. It's just constant back and forth. It's the circus. Okay. Anyway, anything else? Amex watching, MasterCard, Visa watching. Some of these trades I've got some exposure in. Uber's fine. Sectors. Let's look at year-to-date sector performance, and I'll go into some currencies and I'll let you go. So here's year-to-date. Not looking good. So where's the best place to hide out this year? And this is what I said. This could be like the sectors of sucking less, right? Consumer staples, good place to hide out. Not a bad sector to hide out. Healthcare, great sector to hide out. Okay. Real estate, utilities, yes. If you're looking for safety and low beta and a non-correlation this year, staples, healthcare, and utilities. The problem is they're still red for the year. So that's not super encouraging. But consumer discretionary at some point will be a great bargain, but it's down 18.5%. Technology, always the more volatile sector, down 20+%. NASDAQ year to date down nearly 14%, in 20+% peak to trough so far. But if you're looking to hide out, utilities often pay good dividends. Healthcare has some growth opportunities, is also a little bit of an AI play. Some of the most common job as we're getting every month is coming in the healthcare sector. We are a service and tech-based economy. Healthcare is going to be this huge boom of like baby boomers retiring, one of the wealthiest generations ever, and needing that extra healthcare, needing workers to fill those roles. And so, again, you can just see performance-wise, these have been the most resilient sectors so far, and probably are a good place to hide out if you're looking for, I still want to be invested, but I want to have less volatility. Well, there's a good place to be stable. Consumer staples, most of these are also low beta and some are dividend plays. Utilities, most of them are low beta and dividend plays. So anywhere between, I'd say like a 3 to 5% dividend is pretty respectable. Staples maybe in like the 2 to 5% range as well. So a dividend portfolio is not all it's cracked up to be. You pay taxes on dividends, so everyone thinks it's free money, but you're paying taxes on it. So it's kind of a wash. But it also feels better to have your money feel like it's moving less to the downside. Mark's down 20% and your portfolio is down 3%. That's cool. The 60-40 portfolio is behaving okay, but bonds are not doing you any favors right now, right? So just a lot of stuff to juggle. I'll say this: look, if you don't want to trade any of this kind of sector rotation, you just want to trade the index, trade gold, trade futures, trade Forex, it's fine. Risk management is going to be the only thing that saves you, right? A year like this, everyone that's watching the stream, if you survive this year, it gets easier from here. Is it possible that the market drops 30% from peak to trough, 35%, 40% peak to trough? Yeah, it's very possible. In this day and age of like everything is super extreme and super fast, I wouldn't be surprised if we somehow find the all-time highest VIX ever. We somehow have like the most historic collapse in the market ever. Like I thought 2008 was bad at 56%. Maybe that's nothing. Maybe that's revisited for no reason other than markets just move faster and it was like an overreaction, but we had a 50+% correction in the market, But if you can survive that, then getting back to those all-time highs is a monster gainer. And if we get back in 2, 3, 4 years, you're doubling your money. So whatever you have invested, if you can survive it, you can do pretty darn well, But that is going to be the biggest key. It's like I'm not in a position right now to be wanting to take lots and lots of high-risk trades. I don't mind taking more trades. I've deployed probably $300,000+ in capital these last 2-3 weeks as the market has been dropping and volatility has been way higher. I've been selling premium because it's been at such a high level that I can go way out of the money, way past the expected moves, and hopefully see some good mechanical trades. But that doesn't mean anything. You know, like it looks good on paper. It's theoretical. But if the market is going to do outlier type moves, I'm still risking trades. And to put it in perspective, 1987 was a 20 standard deviation move. 20, right? This market loses its mind when we have like a 2 to 3 standard deviation move. Oh, did you see that earnings report? It was like a 3 times standard 20, and that was to the downside. So it can happen. Like black swans and outliers can happen. Was this last couple weeks a black swan? Not really, right? I mean, I showed you how easy it was to forecast it. It was just a matter of we just got there fast. I mean, the fact that we got to the technical measurement in 3 days is what rattled this market, right? If it was like, well, we're just once we broke the lows, God, I just if I keep talking like this, I feel like my voice is going to sound like RFK Jr. I don't know. This year, my voice has been like half gone half the time. Anyway, but getting this move here, hanging out around that 200 moving average, a slower grind to the downside would not have been a huge surprise. It wouldn't have been. But the fact that this was measured and broke the lows and just went right to the measured move in 3 days is insane. And that's why everything got so so exaggerated so quickly. But now that the market does that, let's say this is your tuning fork. There's your high low. Well, now the market's probably going to do something like this, right? And we figure out how this all settles in. If the low is safe, we'll figure it out. It's going to get uglier and harder if every time this market is like, hey, up on the day, and then it gaps lower and just tries to revisit lows again, and then up on the day and then flushes, and up on the day and flushes. Just don't be surprised to have some days that just make your head spin. There will be good opportunities, but remember, trade small, control your risk, and think big picture. Like think about, I've got to be in this market for the next 12 months. I've got to be in this market for the next 2, 3, 5 years. If you think with that survival mentality, you will be fine. And I know that may not paint the big picture of how much money you want to make this year, but if you don't survive this year, you're not trading anymore, right? If your risk capital is gone and you have to reset and start over, that's going to take away all of the excitement and hope and all this good stuff about trading. It's gone when you blow up your account. So surviving is the name of the game, and trading small in these environments where we have these wacky, crazy intraday moves, it's annoying to like, well, I'm not making what I want, right? But if you're not understanding how to safely make money in these environments, how to play defense, and how to be nimble and agile with your portfolio, look, the market doesn't have anywhere safe to be. If everything is down systemically, you're screwed. Unless you are short, unless you are hedged, that's a different play. But to be a bear, I mean, talk to anybody over the last 25 years and say, if you're a perma bear, how much money have you made? Because if all you did was make money during 2000, 2001, or make money in 2008, or make money in 20, maybe 15, 16, maybe 2020, I mean, you're getting like one big payday over every 4 to 6 years. That's not sustainable. I mean, I would, and plus the timing of this is so difficult. And all we've seen for the last 15 years is like buy the dip, buy the dip, buy the dip. So point is, bears jump out of windows, and it's difficult to time. It changes everything. Liquidity goes out the window as well, and it's just extremely disruptive, and it's also very irrational. So survival is the best thing. And to survive, you got to trade small. Nothing should be big or guaranteed. I mean, look, I literally don't take any risk higher than probably 1 to 2% on a maximum size. Most of my trades are less than 1%. Every trade I take, risk defined, probably a quarter to 1%. Like quarter 1%, half 1%. 1% is like a pretty big chunk, just because I'm like, I got to like the trade to take a 1% risk, because then I'm just going to trade thousands of times. And that helps. And the same thing was even in currencies. When I traded currencies, I didn't have stop losses when I trade currencies, but I trade so small and so boring that it gave me plenty of time to just manage my trades. I mean, I'm in drawdowns right now. Like I've got 6-figure accounts that are in 8% drawdowns. Okay. But 8% is manageable considering the world just went to the brink of like a, systemic collapse for, 3 days. So we'll see how, I mean, I hope they all come back, and I trust the technicals of the currency market to be efficient, but it's been very disruptive to make like fresh historical lows again on some of the pairs that I'm trading. So the nice thing is there's inefficiencies with that, and I think we'll build back into those. But I trade very, very small to survive that type of calamity, and then I can always add to my winning trades. I just want to see more confirmation. Same thing is true when I'm trading options. It's risk defined. If I really like a trade, then yeah, I'll add more trades to it. I'll add to my core position. If I like a trade, I'll have some stock in it. I'll trade a lot of options for income. I'll lower my cost basis. It's like I'd rather take lots and lots of little bites to build up my trade into the investment that I want, as opposed to I'm all in. This is it. There's my 2%, give or take. Like, it's great when you're right, but it sucks when you're wrong, especially like this when there's nothing good happening. That 2% risk, even though that seems manageable, 2% risk on 10 trades, there's your drawdown for the year and your toast, right? And 2%, like, most traders aren't that small. Most traders trade, 3, 4, 5, 10%. Most traders have no idea how to manage risk, and they blow up. So anyway, I don't need to preach. You get it. If you're still here and trading and surviving, good. Hopefully you're doing it by doing the right things. If you're a little stressed, I understand. You can see why. This has been probably one of the more difficult environments that I've traded in 25 years. But it also wasn't super surprising to see it. It's just there's not much you can do when the market goes from crazy low volatility to high volatility, and does so in 3 to 4 days, which is like, it's one of the wilder moves I've seen since COVID. But if you can survive it, there's plenty of opportunities to be profitable. The bulls will offer you what seems to be an infinite amount of opportunities. The bears will offer you short-term opportunities, but they will offer you all of the lessons to teach you how to protect your portfolio. Because in an event like this, when it's not just a fall and buy the dip and it drops and gets worse, that's usually what scares traders out. If you have a dip, well, that's easy. Well, yeah, I just bought the dip, as we've been conditioned to do for 20 years, But if it's a dip that becomes a third leg, becomes a fifth leg, that was 2022. That was 2008. COVID had like maybe a little 3-wave move. It was so fast in 30 days, it was insane. But a drop, rally, drop, rally, drop, that's 2000, that's 2008, that's 2022. Those are legitimate bear markets that, most traders struggle. So like I said, just be careful. All right. Anyway, I'll let you go for today. I think, what the heck is this? I guess I got to go. I got a webinar in just a few minutes. Okay. I'll let you go for today. Thanks for being with us, and we'll be back at it tomorrow. Thanks.
Thanks for watching today's A1 Trading Show. Be sure to subscribe and to turn on notifications so you don't miss the next one. All month long, you can get the Edge Finder 40% off, our best discount of the year. Check out the links in the description below to visit the Edge Finder homepage, or speak with a team member directly to get the 40% off discount now. Trade safely, and we'll see you tomorrow.